That's one benefit of the cooler weather. I get to wear some nice clothes you guys haven't seen before, huh? Check out the outfit. It's a little bit of a step up from the tank top, although I do miss my shorts and tank top. I'm not complaining. It feels great out here. And today I'm at Tiburon Yacht Club, and we're going to talk about how Americans' emergency funds are continuing to shrink as worries about inflation continues to go up. Doesn't sound like a very good combination, but that's the reality of where we're at right now. First, I want to talk about the emergency fund stuff, and then we'll talk about inflation and the Fed rate cut. You guys probably already know the Fed cut rates by a quarter point. We'll dive more into that a little bit later in this video. But let's first talk about people's emergency savings, because this is something that has been kind of a problem for a while now. The amount of money and the amount of disposable income that people have has been steadily declining since we've seen a big uptick in inflation in 2022. About 1 in 3 Americans right now say they do not have an emergency fund, and the median amount Americans say they have saved for emergencies is $500, according to a survey that was conducted by Empower, which is a financial services company, back in June of this year. Now that's $100 less than a median amount of $600 reported in the same survey 1 year ago. So people's savings have been steadily declining by their own math and by their own admission of how much they actually have saved. And let's face it, guys, these days, having $500, you might as well have nothing. I'm not saying that $500 is nothing or that it's not better than nothing. I'm just saying that if a real emergency arises, it's not going to take you very far. Full-time employees who contribute to their retirement accounts through something like a 401k and have at least $5,000 in their accounts now report holding a median of $20,000 in emergency savings, which is about $5,000 less than the median balance reported just 1 year ago. I mean, that's a big difference, guys. $5,000 less in 1 year. So not only is your money balance, your nominal balance going down, but inflation month over month is continuing to rob you of the purchasing power. So people really are more broke than they were a year ago, by all measures. Most financial planners advise that you have at least 3 to 6 months of emergency fund. I would personally say in times like this, where a lot of people are getting laid off and your job situation could be very dicey, I would say that should be more in the range of 6 to 12 months. And even sometimes that's not enough, because I've showed you guys stories of people who had a really good job, a year and a half ago, lost that job, and they had a sizable emergency savings, sometimes 12 months, and have now blown through that money and are forced into doing gig work just to keep their finances alive. I don't know about you guys, but a lot of these boats are kind of a piece of crap. So this essentially means if you're spending $3,000 a month on rent, groceries, and other living expenses, you need to have at least $18,000 saved up if you want a 6-month emergency fund, but preferably a year's worth would be better at $36,000 saved up. And I know that sounds like a lot of money and a high number for a lot of people, but that's the reality. That's what you should have if you're being financially smart right now and if you are preparing for hard times. I'm not saying you're ever going to need that money, and hopefully you don't. The idea is that hopefully you'll never have to tap into it, and you're going to be able to just continue earning. You're going to get a raise every year, and life is going to be good. But we know that hasn't been the case for many of us lately. And I know when people see numbers like that, it kind of puts them in the mindset, well, why should I even save at all? I can't save $36,000. I might as well just blow everything I make, and then if emergency comes up, I'll use my credit card. But I think that's not a good idea. Even if you can just save 1 month's worth of expenses, that's a start. No, and it shows you that you got somewhere, right? It proves to you that you can do it, and then you can start with another month and another month. And before you know it, you might actually have a 6-month emergency fund saved up within the span of a year, potentially. In fact, according to a recent study by Vanguard, they found out that even just having a $2,000 emergency fund stashed away can lead to better financial well-being, according to a study they did back in May. So even just having a couple $1,000s just in case is better than nothing. But remember, the median balance that people have right now is $500, guys, only 25% of what they should have. So people are very far away from where they need to be. But people that just had the 2,000 bucks had a 21% higher financial well-being score than people who did not have it. And people who had the $2,000 plus an emergency fund had a 34% higher financial well-being score than people that don't have it. Because people that have a higher financial well-being ultimately spend less time thinking about and dealing with their finances and are less distracted by financial problems. You can focus more on work and family and life and fun and not have to constantly be worried about where's the next paycheck coming from? How are you going to pay the bills next month? I gotta say, guys, for this little yacht club being right next to this really nice neighborhood, I am not impressed with a lot of these boats. Like, some of them are nice, but others are just look like they should be at the bottom of the ocean, to be honest. Okay, let's talk about the Fed rate cut. We all know it happened, not a big surprise. But one thing I want to talk about here is where the Fed projects things are going right now, because that's kind of the most interesting part of this story. Jerome Powell said in his speech that they predict the federal funds rate is going to be at 3.6% by the end of this year. Right now, they just lowered it to 4 or 4.25. They're talking a couple more rate cuts at least in order to get there by the end of this year, which is not that far away. Then they're talking only 3.4 percentage points by the end of next year, which means that next year there probably won't be very many rate cuts, maybe just a couple, and just kind of wait and see how these rate cuts have an effect on the economy, sort of like what they did for the majority of this year. Then he says by the end of 2027, the federal funds rate is projected to be 3.1%. So basically, they're kind of committing to a long-term strategy here of cutting interest rates over the next 2 years at a time when inflation is going up. So what does that mean for you? Well, it means that you better have some way to hedge against it, because inflation is guaranteed to be putting a bigger and bigger hole in your pocket month over month and year over year right now. And this decision to cut rates was pretty much unanimous. 11 of the 12 Fed members voted to do this quarter-point rate cut. There was only one dissenter, Stephen Moran, who actually was in favor of an even larger rate cut at 50 basis points. Now, if we look at this chart right here, this is something interesting. This shows us the last 4 rate cutting cycles, including this one, going all the way back to the year 2000. And what do you guys notice? Every time the Fed starts cutting rates, shortly after that, you see this gray line. And that gray line is an official recession, which means that most likely that's where we're headed right now, is into official recession territory. Jerome Powell said that the decline in job growth and the labor force participation has gotten everyone's attention, and he's now saying that the downside risk is a reality and is signaling us away from the inflation first fight onto the concerns of how fragile the job market is. So Jerome Powell essentially stated that there's no risk-free path, and he's acknowledging that there's a trade-off between inflation and jobs right now. And due to their dual mandate, they believe that there's more risk in the labor market than there is with inflation. He's insisting this decision was not made because of political pressure. This was made because this just seemed like the right thing to do. And he says he thinks that they were right in waiting to do anything throughout the year, and only now seems to be like the right time to be dropping interest rates. What do you guys think about that? Jerome Powell also thinks it's going to be easier to manage inflation moving forward, even though somehow over the past 4 years they haven't been able to lower inflation down to their 2% goal. They're still sitting at 3%, so it was so easy to get it down to their goal, even though they didn't reach the goal. And now they're kind of abandoning this in favor of trying to boost the labor market. And just like I said the other day, are these rate cuts really going to boost the labor market? Probably not. Are companies going to magically start hiring more people just because interest rates went down a quarter point? Doubtful. You know who else is doubtful that any of this is going to do anything besides raise inflation? Our bond investors, because the 10-year Treasury went down and then it went right back up, and it's sitting right now, as I'm recording this video, at about 4.1%. And you guys can see this is the Treasury chart going back about a year, which is when the Fed started cutting rates last year, roughly around September of 2024. And what do you notice? ever since they started cutting rates in September of 2024, the 10-year Treasury has been significantly higher than it was a year ago, even peaking at about 5% towards the beginning of this year. I know 4.1% is not 5%, but it could easily continue going up if inflation continues to be a major problem. And some people say that, well, Michael, you talk about all the problems, but you never give us any solutions. Well, that's not true at all. I actually give solutions all the time in my videos, but like I said, most people don't stick around and watch the full 20 or 23 minutes, whatever the video is. People typically watch 5 to 7 minutes and then they're out. So you probably don't hear what I'm actually telling you. So for anybody who is listening right now, I will tell you what you should be doing is you should invest as much money as you can, essentially, into gold, into silver, into gold stocks, if that's your thing, or ETFs. Not my thing. I prefer physical metals, but hey, it's better than not owning anything related to gold. Buy the gold mining companies, guys. Why? Because gold and silver are the only real money that we have in this society. And every time inflation goes up, the value of gold and silver goes up along with it. And that's why fears of inflation are surging right now, because people are realizing that the jig is up. You know, the Fed has officially abandoned its fight on inflation with this latest interest rate cut and is now more concerned about the labor market, which they should be concerned about it. But what good does a job do you if the money you're making is not enough to even pay for normal everyday life, right? So in my opinion, inflation should always be priority number one, but hey, I don't work at the Fed. In fact, the bond markets were predicting that inflation would average 2.4% over the next 5 years. Well, now they're predicting that it's going to average 2.5% over the next 5 years. And that's just an average over 5 years, which is still clearly way above the 2% we're supposed to be at. And these 5-year inflation predictions are now as high as they were since Liberation Day, when the Trump administration announced all of the new tariffs that we have. Even the Federal Reserve's official predictions don't see inflation coming back down to the official 2% target before 2028. So what are they doing cutting rates, guys? Like, doesn't anybody see how hypocritical this is? Why on earth would you be cutting rates if inflation, by your own prediction, isn't even projected to reach the levels that you're trying to get it at until the end of 2028? I mean, how far away is that? We're talking at least 3 more years, and inflation has officially been a problem since 2022 when it peaked at 9.1% CPI. So you're telling me that everybody's supposed to wait a minimum of 6 years to have inflation go from 9.1% down to 2%? Imagine how much money and how much purchasing power you will have lost throughout those 6 years. Or what if you are somebody who's retired right now trying to live on a fixed income, trying to make sure that your assets are keeping up the pace with inflation? Well, good luck with that. Even the cost of living increases that people are getting on Social Security are not enough to keep up with these inflation numbers. Even Jerome Powell says that we are at a risk of a stagflation style economy right now, which is where growth basically comes to a screeching halt, economic growth, and inflation continues to go up. It looks like we're already there. We're already in the light stages of stagflation right now. The question is it going to get worse or better? Well, if they keep making foolish moves like this, it's probably just going to continue to get worse. And the other thing that we need to talk about is inflation doesn't hit everybody the same, okay? People are not equally affected by inflation because it really highly depends on where you live. It depends on your lifestyle, the type of things that you buy, whatever, your standard of living. All of this really highly depends on what level of inflation that you personally experience, okay? But according to a new Wallet Hub study, they compared 23 major metropolitan areas using key consumer price metrics like changes over the past 2 months and over the past year. And here's what they found. Metropolitan areas in Florida and California are experiencing the most severe inflation problems, with rates almost double the target rate of 2%, meaning that in most of California and Florida, you're easily feeling about a 4% inflation rate right now, probably even more than that, because this is all using official data. They say that San Diego, California is ground zero for inflation right now, where people there are experiencing about a 4% year-over-year inflation rate. Tampa, Florida is not far behind at a 3.3% year-over-year inflation rate. Philadelphia is experiencing a 3.3% inflation rate right now. Anchorage, Alaska, they're at 2.4%, and Chicago is at 3.1%. The New York and New Jersey metropolitan area, they're at about a 3.2% annual inflation rate right now. But if you live in Texas, for example, in Dallas, Fort Worth, then you're only experiencing an average of about a 0.9% annual inflation rate, which is not nearly as bad as some of these other areas we talked about. I remember just a year ago that Miami was at the top of this list, where Miami was experiencing the highest inflation rate in the nation. So it's like, it doesn't even really matter what the official numbers are, because you can take whatever the official numbers are and double or triple them, and then depending on where you live, tack on the extra there. But don't worry, we got to save the job market, because without a job, nobody's going to be able to pay for all this ridiculous inflation. So I think that's where the motivation really comes in. When you start seeing the full picture, it's like, well, they want people to have jobs, because if they have jobs, then they can pay for all of the inflation, or at least they can try to keep up with paying for it. Versus if people don't have jobs and we're experiencing all this inflation, then inevitably we're going to have to go to deflation, because it's going to be the only way that anyone's going to be able to afford anything. So I feel like this rate cutting cycle is more of a reflection of the ultimate motives of the Fed and the government, which is just to kind of keep you just poor enough where you can continue making some payments and keeping up with a lot of the inflation, but not all of it, and still in general falling behind, but not too far behind, so you can still spend some money in the economy. And we know that so far their plan is working, because the U.S. retail sales, they have increased strongly even with the softening labor market. Take a look at this. U.S. retail sales rose 0.6% in August, beating the expectations of only 0.2%. And this marks the third consecutive monthly gain in retail sales. Sales were up 5% year over year, although inflation-adjusted growth was closer to 0.2%. Think about that number for a minute. Inflation-adjusted growth is only up 0.2%, and that's using official inflation numbers. So when we look at what inflation really is, there probably actually was no growth in sales. It might even be negative, but the nominal sales growth is showing an improvement, that people are spending more. Well, of course they're spending more, because everything costs a whole lot more than it did a year ago, or 2 years ago, or 5 years ago. According to the data, though, the biggest gains were in sporting goods, up 1% year over year. Restaurants and bars were up 0.8% year over year, and online sales are up 2% year over year. Another thing that they note here in this story, just so everybody is aware, that the costs of the tariffs are also largely being absorbed by U.S. businesses and consumers, not foreign exporters, is who the tariffs are aimed at. They're supposed to be paying for it. But like I told everybody on this channel when the tariffs were first announced, that you're going to pay for it in the form of higher prices. And that's exactly what's happening right now. But how do you suppose retail sales are going up at a time when job growth is slowing, unemployment is on the rise, and companies are hesitant to hire people for any new jobs right now? How are we seeing a situation where retail sales go up? Oh, that's right, because the cost of everything at the retail sites and stores is more than it was a year ago, so naturally it's going to go up. I've shown you guys numerous examples of things that I have purchased. You know, I purchased something a year ago or 2 years ago, like the Meeson cookware example I shared with you here, the Adidas shoes. Everything is more, guys. Like, we're talking anywhere between 40 to 60% more than it was just a year or two ago. That's a major increase. And we also just talked about at the beginning how people have less savings than they did a year ago. So how are retail sales going up? Oh, that's right, because prices are higher. It's not because people have more money. It's not because the economy's doing better than it was a year ago. It's simply just inflation, guys. So when you read this stuff, don't be fooled by it. Don't think this is a sign that everything is rebounding and everything's going to come back to normal and that the tariffs are working and we're going to be back to having the strongest economy ever. That's like the furthest away from the truth right now. And the thing is that all of this artificial extra spending, these higher retail numbers help bolster GDP because in fact the Atlanta Fed raised its Q3 GDP estimate to 3.4%, up from 3.1%. And remember, since 80% of GDP is based on spending in this country, well, naturally, it's going to be going up roughly at about the clip of inflation, which is right about there. The official core inflation numbers are at 3.1%, and 3.1% was their Q3 estimate of where GDP was going to be until now. Now it's at 3.4%, which kind of suggests that they think inflation is going to get even worse. So I hope you're ready. Like I said, buy gold, guys. Buy silver. Buy Bitcoin. Buy the gold mining stocks. Buy the gold ETFs for all I care. It's better than nothing. You need to have every single protection you can have with your finances right now and protecting as much of your money as you can against inflation. And the only other thing you can do besides make those investments is to try to out-earn it. Try to out-earn yourself. Try to increase your income each year. Make sure you are out of debt so you're not paying high interest debt or any interest on any debt for that matter. And that will help you stay 2 or 3 steps ahead of this inflation nightmare that we're all living through. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.